Hello, and welcome to J. Mike Mortgage. I have 30 years of experience in the mortgage business. My name is J. Mike Perkins, and this is the first in a series of videos on common mortgage mistakes and how to avoid them. So let's start with mistake number one, which is right up front, and that is getting a bad mortgage pre-approval. I'm going to go over it in 4 sections. First of all, a typical nightmare scenario, so I can show you that a bad pre-approval just equals pain. Next, I'm going to go over what a pre-approval is, and then the steps that the lender does to come up with the pre-approval, and then finally 6 scenarios. And if one of these applies to you, then I strongly recommend that you get your documents to the lender up front and be certain that they review them. Otherwise, you may get a bad pre-approval. I'm assuming that you're going to be applying for a standardized mortgage type, something like a conventional conforming mortgage, an FHA Federal Housing Administration mortgage, or a VA Veterans Administration mortgage. Now, these mortgage types make up the majority of the market. However, there are other loan types out there, and their procedures may be slightly different. And of course, mortgage guidelines are always subject to change. Finally, if you enjoy this video, then please help my channel by hitting like and subscribe. A bad pre-approval really can cause pain, and for everyone involved in the transaction. In my career, I have done thousands of pre-approvals, and when things go bad, it's usually a situation like this. Everyone's in a rush. You get a request to do the pre-approval late Friday afternoon because they want to buy a house first thing in the morning on Saturday. You look over the application and you realize it's one of those where you need documents from the borrower. Otherwise, you really can't give them an accurate answer on how much they'd be approved for. But they don't have any of their documents and they need that pre-approval right now. So you do it based on the best information that you have. They go out and buy the house on Saturday. Then next week, you get a copy of the purchase contract along with the documents that you need from the borrower. You review everything, and then you realize to your horror that they don't actually qualify for the mortgage and the pre-approval that they bought the house with. So you've got to cancel the deal, decline them for the loan, and everybody is upset. They're going to get a ton of paperwork even though the deal is dead, and they have to sit around and wait for a refund of their earnest money. So what is a mortgage pre-approval? Well, unless you're paying cash, it's something that most sellers want before they will accept your offer to buy the property. It's not a real loan approval. You can't get a real loan approval until you have a property address. It's really an opinion letter from a loan officer, and it says something like this. It says they pulled your credit. They've received information about your employment, your income, and your funds to close, even if that information has not been verified. And they believe, based on the information that they have, that you would most likely qualify for a particular type of mortgage up to a given sales price and loan amount at current interest rates. Let's go over the steps to do the pre-approval. The first thing you'll do is complete an application for mortgage loan pre-approval. Typically, that will be done online or over the phone. Then the lender will pull a 3-bureau credit report. Next, the lender will review the credit report along with the other information that's on the application. They'll contact you and they'll ask for copies of certain income and asset documents. If you provide the documents, they will review them. If no documents are provided, the lender will issue the pre-approval based solely on the information that's on the loan application, and then they'll state that that information needs to be verified. Assuming the credit, the employment, the income, the debt-to-income ratio, and the funds to close look acceptable, the lender will issue a pre-approval letter at a certain sales price, loan amount, and say it's at current interest rates. Although the pre-approval letter will be based on a sales price, what the lender is actually approving you for is a maximum mortgage payment amount. And the payment amount that the lender uses to qualify you will always include principal and interest, along with taxes, insurance, homeowners association dues, and any other mandatory assessments on the property, even if those are paid outside of the mortgage. The maximum mortgage payment amount that you'll be pre-approved for will be based on what's called the debt-to-income ratio. And the debt-to-income ratio can't be higher than what's allowed for the mortgage program that you want to get. Conventional has the most restrictive debt-to-income ratio limit, and it's pretty firm at around 45%. FHA will go higher. Typically, they may go as high as 56%, maybe more if the lender allows it. VA has a debt-to-income ratio requirement similar to FHA, but you also have to meet a secondary VA income standard known as having sufficient residual income. One of the biggest reasons that pre-approvals end up being bad is because the information that's being used to calculate the debt-to-income ratio up front, that information ends up being wrong. The debt-to-income ratio is just what you think. It's your debts divided by your income. So if you had payments of $2,500 a month and you had income of $5,000 a month, you would have a debt-to-income ratio of 50%. And the debt-to-income ratio is important because that determines how much of a mortgage payment you can qualify for, therefore how much house you can buy. But if you are in a hurry, you don't have the borrower's documents, or you make some assumptions about the property that are wrong, it can throw everything off. Without documents, it's easy to miss a payment that you need to count in the debt-to-income ratio, but you didn't because you didn't know it was there. If you assume the borrower is going to buy in an area that has very low property taxes, but they end up buying somewhere else that has very high property taxes, that's going to throw it off. If you assume the borrower is going to buy a single-family detached home, but they end up buying a townhome in a planned unit development that has a large maintenance fee that you have to count in this housing cost, then that's going to throw the debt-to-income off. And then finally, if you have any kind of variable income, the number that the borrower puts down may not be the number that the lender comes up with, and that's going to throw this thing off. As far as income is concerned, you're probably okay if you're on a straight salary and every paycheck is the same, you've been on the same job for 2 years, and you qualify for the mortgage based solely on your salary. Then your income should be easy to determine. But let me give you some cases where you really need to get the documents to the lender up front, or you may get a bad pre-approval. You know, borrowers look at the world one way, but the lender looks at the world differently. And that's the major cause of bad pre-approvals. Here are 6 scenarios that, in my opinion, need some extra attention up front. The first one is if your hours worked vary every week, or you are depending on overtime income to qualify for the mortgage. The problem is that the loan application doesn't have a lot of instructions, and borrowers may just put down the number that they made on their last pay stub, not realizing that what the lender is going to do is come up with an average number after they send out employment verification forms. And if that average number ends up being lower than what you put down, you may have a bad pre-approval. The same situation applies to bonus income or commission income. The lender's going to do an average of that income. They're going to want to see that you have a history of making bonus income and commission income of 2 years or more. And if there's any kind of a one-time bonus that's not likely to be paid again in the future, then there's a good chance the lender will not consider that. If you're self-employed, the lender needs to review your tax returns, or it's almost impossible to figure out what number that they're going to come up with to qualify you for the mortgage. I did a video on Schedule C self-employment income explaining how the lender calculates it, and I'll put a link to that in the description. But if this applies to you, the lender needs copies of your personal tax returns for the last 2 years. If you own a business and the business files a separate business tax return, then the lender is also going to want a copy of that for the last 2 years. If you've got income other than employment that you're trying to use to qualify, for example, trust income, investment income, and some types of retirement income other than something like Social Security, which is easy to verify, the lender is going to need to see that information. They're going to want to believe that that income is going to continue for at least the next 3 years, and they may calculate it slightly differently than you do. If you've got child support income that you need to qualify, but the payments have varied over the last 2 years, that's a situation that the lender needs to review. If you have any kind of unusual job situation, if you changed occupations in the last 2 years, or you have gaps in your employment of more than 30 days, or you have less than a 2-year work history in the United States, that's the sort of thing that the lender should review up front. And finally, if you've had a foreclosure or a short sale and the date that you think for the foreclosure and the short sale is getting close to the minimum time period that you have to wait, you should have the lender go ahead and verify the actual date of the foreclosure or short sale, because it's been my experience that the date that you think it happened may not be correct. Thank you very much for watching this video all the way to the end. If you found this information useful, please help my channel by hitting like and subscribe, and consider leaving a YouTube comment and sharing. Thank you very much. On behalf of J. Mike Mortgage, this is J. Mike Perkins.